If you had one flat tire, would you want to pay for four new tires instead of just one? Yeah, the other three may come in handy someday, but that money might be better spent now on something else. Well, there's a parallel here with options trading. Recall that the maximum profit potential of a long call option is unlimited. But what if a trader is only expecting a small move in the price of a stock? Is paying for something that has unlimited profit potential worth the cost? For some traders, the answer is no. Instead, they can decide to buy what's called a call spread. A spread trade costs less and has a lower break-even point compared to buying a single call. However, it also has limited potential for profit. If you're unfamiliar with how single leg options work, check out our introductory lessons on options or join a masterclass. But for those of you who are still watching, let's get into it. Buying a call spread is also called a bull call spread. As the name suggests, it's a bullish strategy using call options. It consists of two option legs. The first leg is a long call, and the second leg is a short call at a higher strike price. Both calls have the same expiration date. Let's use an example to illustrate. To keep things simple, we'll skip over commissions and other fees. However, spread trades can be more expensive to trade than single leg options, so check with your broker to understand their fee structure before trading option spreads. An option trader named Jack has been looking at the stock chart for ABC1 Corp and thinks the stock has a good chance of increasing from $50 to $55 within the next 30 days. He can buy a $50 call for $4, making his break-even point $54. His maximum profit potential is theoretically unlimited, and his maximum risk is his total premium he paid of $400. Now what if Jack were to buy a call spread instead? He can buy the same $50 call for $4 and sell a $55 call for $2 to reduce his net debit to $2, for a total premium paid of $200. That premium paid is also his maximum loss. In this example, Jack has the right to buy the stock at $50 per share and is obligated to sell at $55 per share. The difference between the two strike prices is $5, also known as the width of the spread. I know what you might be thinking. Since the width of the spread is $5, Jack's maximum profit potential is $500. You're on the right track, but first we need to factor in the net debit of $2 that Jack pays for the spread. This means that his maximum profit potential is $500 minus $200 for a total of $300. Calculating the break-even point can seem difficult at first glance, but I'm going to let you in on a little secret that will help you figure it out in 2 steps. Step 1. Determine the net debit or credit of the spread. We've already figured out that Jack's net debit is $2. Step 2. If it's a call spread, add the debit or credit to the lowest strike price. And if it's a put spread, subtract the debit or credit from the highest strike price. Since this is a call spread, we'll add the $2 to the lowest strike price, which is $50, meaning the break-even point is $52. A key point to remember is that the break-even point should always land between the two strike prices of the spread. Jack's maximum loss is a little easier to calculate. It's simply the premium he paid, $200. Now that we have both trades broken down, let's compare them. The single leg trade has a theoretically unlimited profit potential, but the spread trade is limited to a maximum profit of $300. The break-even point of the single leg trade is $54, while the break-even point of the spread trade is $52. The maximum loss for the single leg trade is $400, whereas the maximum loss for the spread trade is only $200. As you can see, the single leg trade offers the greatest potential for profit, but it also costs more and has a higher break-even point. The spread trade, on the other hand, doesn't offer the potential for unlimited profit, but it's cheaper, not to mention profitable sooner than the single leg trade. That's the trade-off between buying a single call and buying a call spread. So which one should Jack choose? The answer depends on how comfortable Jack is with his expectation of what the underlying stock price is going to do within the next 30 days. If he thinks that the stock could rise above $55, he might consider the single leg trade's higher cost and break-even an acceptable trade-off for the possibility of a higher profit. However, if Jack firmly believes the stock won't go above $55, he might be okay with giving up the opportunity of unlimited profit in exchange for a lower break-even point and maximum loss. Let's summarize what we've learned about buying a call spread. It can also be referred to as bull call spread. The strategy is made up of two option legs with calls. The first leg is a long call, and the other is a short call with a higher strike price. Traders want the underlying price to go up. Their maximum profit is limited to the spread between the strike prices minus the net debit paid. Their maximum risk is the net debit paid, or simply the net cost of the trade. And their break-even point is the strike price of the long call plus the net debit paid. So back to my question at the start of the video. If you have one flat tire, would you pay for 4 new tires? What if you reduce your total cost by selling the 3 unused tires to someone else? Now that's thinking like an option spread trader.